On February 26, 2022, the US and Europe fired the financial nuclear weapon. They cut Russia off from SWIFT and froze $300 billion in central bank reserves. The West celebrated the collapse of the ruble and the imminent crippling of the Russian economy. But the celebration was premature. 2 years later, Russia stabilized, its trade rerouted, and its economy grew faster than Germany's. The financial nuclear option failed to achieve its tactical goal. Worse, it achieved a devastating strategic one. It taught the world to build defenses. This was the fatal turning point. This act didn't prove the dollar's power. It revealed its weakness. Because this pattern isn't new, it's the Five-Stage Backfire Pattern that has repeated 4 times in the last century. Every time the dominant global power weaponizes its financial system, it inadvertently destroys the foundation of its own dominance. Britain fired this weapon in 1914 and lost reserve status in 30 years. The US fired it in 2022. The clock is ticking. The destination is the same, the end of dollar hegemony. This is the documented history of financial weaponization, the mathematical proof that the dollar is already in irreversible decline, and the definitive timeline for the post-dollar world. Chapter 1. The Fatal Precedent. How Weaponization Kills. Hegemony. 1.1. The Anatomy of the Swift Cutoff. The Nuclear Option. Defined. The weapon wasn't the tank, it was the transaction. On February 26, 2022, the US and EU announced they would cut major Russian banks off from SWIFT, Society for Worldwide Interbank Financial Telecommunication. SWIFT is not a bank and doesn't hold money. It's the messaging system that connects 11,000 banks in 200 countries, processing $5 trillion in transactions every single day. Cutting Russia off was the nuclear option because it meant Russian banks couldn't easily send or receive international payments, crippling trade and imposing economic isolation. The immediate effect was shock. The ruble crashed 30%. Western media declared victory, predicting Russia's collapse within months. But the tactical success was fleeting. Russia stabilized its economy, hiked interest rates to 20%, and forced European countries to pay for gas in rubles, creating artificial demand for the currency. The ruble recovered its losses within 3 months. By 2023, Russian GDP grew 3.6%, faster than major European economies. The strategic consequence, however, was terminal. Every country watching, China, India, Saudi Arabia, Brazil, saw the ultimate display of financial coercion and realized an existential truth. If the US could freeze $300 billion in Russian central bank reserves and cut off its financial lifeline for political reasons, it could do the same to anyone. The precedent was set. 1.2. The 4 historical precedents. Financial weapons always backfire. This weaponization follows an immutable recurring pattern. Every time a dominant power uses its financial infrastructure as a political weapon, it accelerates its own decline. Precedent. 1. Britain in World War I, 1914. Before World War I, the British pound sterling was the world's reserve currency, controlling about 65% of international reserves. When war began, Britain passed the Trading with the Enemy Act, seizing German-owned assets, bank accounts, and property across the British Empire. This shattered the historical norm that finance was separate from warfare. The backfire. Neutral countries realized their money in London was no longer safe unless Britain approved of their government. They began diversifying their reserves into gold and establishing accounts in New York and Paris. The result? The US benefited enormously, holding more gold reserves than Britain by 1920. By 1944 at Bretton Woods, the dollar formally replaced the pound, a 30-year decline from weaponization to replacement. Precedent 2. The United States and Iran, 1979. When Iranian revolutionaries took American hostages, President Carter froze all Iranian assets in US banks. About $12 billion. This was the largest asset freeze in history at the time. The backfire. OPEC countries and oil exporters realized that dollar reserves held in US banks could be seized via a simple executive order. Their sovereign wealth was no longer truly sovereign. The result? In the 1980s, OPEC and other countries diversified their reserves away from the dollar, increasing holdings of Deutsche Marks, yen, and gold. The dollar's share of global reserves began a slow, continuous decline. Precedent 3. The United States and Russia, 2014. After Russia annexed Crimea, the US imposed targeted sanctions but notably did not cut Russia off from SWIFT. The mistake. This action signaled US intent but allowed Russia 8 years to prepare. The preparation. Russia systematically reduced dollar dependency, cutting US Treasury holdings from $130 billion in 2013 to $2 billion by 2020, and massively increasing its gold reserves. Russia also developed SPFS, System for Transfer of Financial Messages, its own version of SWIFT, and negotiated non-dollar trade deals. Russia explicitly stated the US uses the dollar as a weapon and built the infrastructure for non-dollar trade. The lesson. The calibrated sanctions of 2014 were the worst option, giving the target time and motivation to build alternatives that proved effective in 2022. 1.3. The Five-Stage Backfire Pattern, the irreversible trajectory. These 4 precedents reveal an identical 5-stage backfire pattern, a trajectory the U.S. is currently locked onto. Stage 1, dominant power controls payment system. The U.S. controlled SWIFT because most transactions settle in dollars through New York banks, giving the Treasury and Fed decisive leverage. Stage 2, weaponizes it for foreign policy. From 2001 onward, the U.S. normalized financial warfare, culminating in the 2022 SWIFT cutoff and the freezing of Russian reserves. Stage 3, targets find alternatives. Russia proved you can be cut off from SWIFT and the dollar system and survive, utilizing SPFS, CIPS, China's cross-border interbank payment system, and non-dollar trade. By 2024, 40% of Russian trade was conducted in non-dollar currencies. Stage 4, neutral countries hedge. This is the critical turning point. Dozens of non-sanctioned countries, fearing future U.S. coercion, accelerated their diversification away from the dollar and SWIFT. Stage 5, original weapon loses power. The dollar's dominance fades, and SWIFT becomes one of several payment systems instead of the monopoly. The U.S. is currently in Stage 4, rapidly entering Stage 5. Chapter 2. The acceleration of de-dollarization, Stage 4 in action 2.1. The hedging strategy. Why U.S. allies are ditching the dollar, Stage 4 is not about enemies. It's about allies and neutrals hedging against perceived U.S. unreliability. The freezing of Russia's $300 billion in central bank reserves was the moment the world's central bankers realized their assets were conditional. The China pivot. CIPS, gold and treasury dumping. China is the primary beneficiary and accelerator of de-dollarization. Treasury dumping. China has reduced its U.S. Treasury holdings from $1.3 trillion in 2013 to $775 billion by 2024. Gold accumulation. China has massively increased its gold reserves, officially holding 264 tons, with unofficial estimates often much higher. CIPS expansion. China's CIPC system, its direct alternative to SWIFT, is scaling exponentially. CIPS processed $27 trillion in payments in 2023, more than double the volume of 2020. CIPS now connects over 1,400 financial institutions in 110 countries. The petrodollar break, Saudi Arabia and the oil shift. The petrodollar system, where oil is priced exclusively in dollars, has been the structural foundation of dollar demand for 50 years. That monopoly is now broken. Saudi acceptance of yuan. In March 2023, Saudi Arabia, a U.S. ally for 80 years, announced it would accept yuan for oil sales to China. BRICS membership. In December 2024, Saudi Arabia joined BRICS, signaling a definitive shift away from exclusive U.S. alignment. Multi-currency trade. The UAE is settling trade with India in rupees and dirhams. Russia sells oil to India in rupees. The dollar is no longer required for the world's most critical commodity. 2.2. The BRICS bloc, building the multipolar currency world. The expansion of the BRICS group, Brazil, Russia, India, China, South Africa, is the clearest signal of an organized alternative to U.S. financial dominance. Massive scale. BRICS expanded to 9 members, including Saudi Arabia, Iran, UAE, Egypt, and Ethiopia, collectively representing 45% of the global population, 36% of global GDP, and 42% of global oil production. The BRICS Currency Project. At the 2023 BRICS Summit, members announced development of a BRICS common currency backed by a basket of commodities, including gold, oil, and rare earths. While not yet implemented, the clear signal is the intentional creation of an alternative financial architecture. India's autonomy. India provides a crucial template for middle powers. India maintained relations with Russia, bought Russian oil at discounts, and settled in rupees, facing no serious consequences from the U.S. This demonstration shows that U.S. financial omnipotence is a myth. 2.3. The data. Confirmed stage 5. The weapon is losing power. The de-dollarization trajectory is not a prediction. It is observable fact, already accelerating at an unprecedented pace. The dollar's plunge in global reserves. The $8's share of global reserves has fallen from 71% in 1999 to 58% in 2024. This 13 percentage point drop represents trillions in diversification. The crash in trade settlement. The dollar's share of international trade settlement has dropped from about 73% in 2022 to roughly 58% by 2024. This 15 percentage point drop in just 2 years is the fastest de-dollarization in history. Central bank gold mania Central banks bought over 1,000 tons of gold in 2022, 2023, and 2024. This is the highest sustained buying since the 1970s, precisely the period leading up to the collapse of the Bretton Woods system. Countries like China, Russia, Turkey, and India are converting dollar reserves into gold because gold cannot be frozen or sanctioned. The SWIFT weapon worked tactically in the short term, but strategically it failed. It accelerated the dollar's decline, and the financial system is rapidly reorienting around alternatives. Chapter 3. The Post-Dollar World. Timeline, Winners, and Losers. 3.3.1. The Timeline to Non-Hegemony, 2037-2047. We can project the dollar's timeline based on the British precedent and modern technological acceleration. Britain's financial weaponization in 1914 led to the dollar replacement in 1944, a 30-year decline. Technology. Multiplier. In 1914, building alternative payment systems took decades. In 2024, CIPS scaled from $12 trillion to $27 trillion in just 3 years. Digital payment systems scale exponentially, meaning the decline will be faster. The projected window, based on historical pattern and current acceleration, the U.S. has roughly 15 to 25 years from 2022. This places the dollar's loss of dominance, falling from 58% to roughly 35-40% share of global reserves between 2037 and 2047. 3.2. The end of the free lunch. Consequences for the U.S. When the dollar's share of global reserves falls below 40%, the U.S. loses the exorbitant privilege that defined its hyperpower status, the debt crisis. Currently, the world needs dollars for trade, so foreign countries buy U.S. Treasuries, allowing the U.S. to run perpetual $2 trillion deficits at low interest rates. When foreign demand for Treasuries collapses, U.S. interest rates will spike. The U.S. must then either balance its budget or face runaway inflation. Falling living standards. The U.S. standard of living, which relies on importing more than it exports and paying with printed dollars, becomes unsustainable. The average American household, accustomed to cheap foreign goods, will face prices rising significantly as the dollar loses purchasing power. Normalization. The U.S. will not become poor, but it will become normal, a large, rich country, but no longer the hyperpower. 3.3. The multipolar map, winners and losers. The decline of the dollar will trigger the largest geopolitical shift in 80 years, creating clear winners and losers. The winners. China. China is the obvious successor. It has the largest manufacturing base, the largest trade volume, and its CIPS system is scaled to rival SWIFT. The yuan will rise as the dollar declines. Russia. Russia wins strategically. It proved the myth of U.S. financial omnipotence wrong and has successfully recentered itself as a leader of the anti-dollar bloc. BRICS nations. They gain financial autonomy and leverage, no longer trapped in dollar dependence. Gold. When countries lose trust in fiat currencies, they buy gold. Gold purchases by central banks are at 50-year highs and will continue to rise. Alternative systems, CIPS, India's UPI, and other non-dollar payment systems will continue to gain market share exponentially. The losers. The United States loses financial hegemony and the ability to run unlimited deficits, leading to a fall in relative living standards. Europe. Europe tied itself to the U.S. sanction policy, freezing Russian reserves and accelerating the dollar's decline without aggressively positioning the euro as a viable alternative. Europe becomes economically subordinate to both the U.S. and China. SWIFT loses its monopoly and becomes one of several payment messaging systems, weakening its business model. Dollar holders. Anyone holding dollar-denominated assets, including U.S. Treasuries, faces persistent inflation and devaluation as foreign investors flee to other assets. 3.4. Conclusion. Financial suicide. The SWIFT weapon looked powerful in February 2022, but financial weapons are like nuclear weapons. You can only use them once. After the use, every potential target builds defenses. The U.S. could have maintained dollar dominance through economic strength and free trade. Instead, it chose financial weaponization. The five-stage pattern is irreversible. The U.S. weaponized the tools of its own dominance, and the backfire is systemic. Historians will look back at February 2022 and say, that's when American financial dominance ended. They just didn't know it.